It was October 19, 1987, Black Monday. I was at my desk on the floor of the New York Stock Exchange, and in 45 minutes, I watched $2.3 billion of my clients' capital evaporate. Panic hit like a sledgehammer. But while everyone else was screaming, I got a call from a colleague at Renaissance Technologies. He told me about this guy Jim Simons, a math professor who hadn't lost a dime that day. I didn't believe him. So I flew to Long Island to find out how. When I walked into Renaissance's office in East Setauket, it looked like a physics lab. No Bloomberg terminals, no shouting. Just servers humming at 85 degrees and mathematicians staring at screens. Simons told me he'd spent 6 years analyzing 50,000 distinct market patterns from 1976 to 1982. He didn't care about news or earnings. He just wanted correlations. I remember asking, what about the human element? He laughed. That's noise, not signal. Listen, if this story is resonating with you, do me a favor. Smash that like button so more people can hear what Jim Simons figured out. Share this with someone who's still trying to trade on gut instinct, they need to see this. And follow my channel, because I've got more insider stories from behind the curtain of Wall Street's biggest secrets. When Simons launched the Medallion Fund in 1988, he raised $100 million from a handful of wealthy investors. I was invited to put in $2 million. I passed. I thought he was insane, a codebreaker from the Cold War trying to trade currencies with algorithms. But by 1990, Medallion was up 71% after fees. I remember staring at the statement in my office, my hands shaking. I'd turned down a 71% return because I didn't understand the math. That mistake cost me nearly $1.4 million. I had lunch with one of Simons' early hires, a cryptographer who'd worked on breaking Soviet codes at the NSA. Over steaks at a diner, he told me the secret: they weren't predicting prices. They were predicting the probability of a price moving a certain way, then betting on that probability across 100,000 trades a day. If a trade had a 51% edge, they did it millions of times. I asked how they handled losses. He said, "We don't care about one loss. We care about the string of 10,000. By 1993, Medallion had returned 500% since inception. Wall Street analysts called it a statistical anomaly, a 5-year lucky streak. But I'd done my homework. I'd seen their trade logs from the Gulf War in 1991, when markets went haywire. While everyone else lost 12%, Medallion was up 32%. That wasn't luck. That was a system that didn't flinch. I started quietly moving my personal capital into their fund, $500,000 at a time, using shell accounts so my bosses wouldn't know. One afternoon, I begged Simons to let me join his team. I offered to work for free for a year. He looked at me, this rumpled guy with a calculator in his pocket, and said, "You're too Wall Street. You're contaminated." He only hired physicists, mathematicians, and codebreakers. No MBAs, no traders. He told me, "I don't want anyone who thinks they know how markets work. I want people who ask how data works." That hit me hard. I'd spent 15 years thinking I was smart. He showed me I was just trained. In 1994, interest rates spiked and Medallion hit a drawdown of 17% in 1 month. Investors panicked. $40 million was pulled. I got a call from Simons himself, a rare thing. He said, "We found a flaw in our volatility model. We fixed it. Now we're adding leverage." I thought he was insane. But that year, Medallion returned 71% net. Simons made $700 million personally. I realized then that true genius isn't avoiding mistakes. It's exploiting them faster than anyone else. By 1999, Medallion had averaged 40% returns annually for 11 years. The SEC was sniffing around, and investors were begging to get in. Simons made a decision that shocked everyone. he closed the fund to all outside investors. Only Renaissance employees could put money in. I remember getting the letter. It felt like being dumped by a girlfriend you never really had. But I understood. Why share a money printer with strangers? Today, Simon's employees are worth an average of $50 million each. After years of studying Medallion's public filings and publishing papers, I built my own stripped-down quant strategy in 2003. I used only 3 variables: momentum, volatility, and a simple correlation matrix. I ran it on 200 stocks, 500 trades a day. That year, my little system returned 29% while the S&P was up 11%. My partners thought I was a genius. But I knew the truth. I was just copying the blueprint, not inventing the cathedral. Simon's was light years ahead. When Simon's retired as CEO in 2009, Medallion had generated over $50 billion in cumulative trading profits. Think about that, a guy who never worked on Wall Street, never managed a portfolio, never went to business school. He just followed the numbers. I saw him speak at a conference that year. He said something I'll never forget: patterns are everywhere. You just have to be willing to look at data without any ego. I think that's what separates him from every trader I ever knew, including myself. Today, I run my own fund. I don't try to beat Medallion, no one can. But I use Simon's core ideas, build systems, ignore noise, bet on probabilities not predictions. Last year, my fund returned 23% while half my peers lost money. Every morning, I look at a photo of Simon's holding a blackboard with equations. It reminds me that the edge isn't in being smarter. It's in being more systematic. That's the lesson that turned me from a trader into an investor.